How to read a startup term sheet. First aspect is whether the term sheet is binding or non-binding. If the investor has given a binding term sheet, it means after due diligence of the company, maybe the price at which he's coming in decreases, but it's a binding term sheet and the investor will invest. Non-binding means that even on the last day, it's up to him to walk away and say that I'm not investing. Company valuations are given in the term sheet, at what value he's coming in, what percentage he'll take, and also whether he's coming in with preference shares. Are they convertible? Are they non-convertible? Are they cumulative? Do they bear a coupon? Coupon means that preference shares and debentures, they are quasi-debt, quasi-equity instruments. They're half debt, half equity. So till the time they are converted to equity, they can have an interest rate like a debt. So the interest rate on debentures and preference shares is called coupon. So I've seen term sheets with coupons ranging from 0.5% to 8.5% to 13, 14%. But if the interest rate is more, then the investor is actually not doing a justice to you, because he's charging 8, 9%, 12, 14% interest from a startup. So he's actually not helping things out. But it may be that, I saw a $5 million term sheet given by a venture capital fund with 14% interest rate. So they were actually not wanting to come in at lower valuation. So they gave interest rate, and the founder said, no, we really want you there on the cap table, on the capital table. So he said, okay, then you pay me proper interest. So this happened. So anti-dilution means that suppose I came in with 1 crore investment, a 10% equity at 10 crore valuation. In the next round, instead of the valuation going up, the valuation in the next round was less than 10 crores, say 5 crores. So my 1 crore investment has become 50 lakhs. So I would say I have an anti-dilution clause. So you give me additional 50 lakh worth of shares. So my shareholding in the new valuation also is protected, my percentage shareholding. ESOPs mean that these startups are many times unable to pay market salaries. So they give you employee stock option plan, ESOP. So these are actually equity shares which will be issued to you in a vesting period. Vesting period would mean 1 year, 2 years, 3 years. And they will be issued at a certain valuation. And they mostly come from the founder's shares. They don't come from the investor's shares. And this is a very popular way of incentivizing employees in startups. Then there are conditions precedent and conditions subsequent. So condition precedent would mean, of course, clauses like whatever information you have given to the investor, it is true. And it is, so those conditions which are bare minimum before signing of the term sheet. Condition subsequent would mean that once the investor has signed, then there will be certain conditions which have to hold true. So like maybe representation on board of directors and so on. Then voting rights, we have already discussed. Board of directors, you suppose an investor is coming in with 25% equity. So he will say that out of the 4 seats on the board of directors, you give me 1 seat. So he is entitled to that seat. So that's how it works. Then reserved matters is very important. So the investor says, I'm coming into the company, but there are some decisions of the company on which I have to be necessarily consulted. So those are decisions like if company is selling some major asset, if company is going into a merger and acquisition, if company is buying a new company, if company is getting a high paid CXO like crore salary or something. So on all these matters, the investor puts in reserved matters. And in these matters, the concurrence of the investor is a must. Then there are info rights, like the investor says, every month I need the update on financials and the performance of the company. Every quarter, I need a quarterly financial report. I need audited annual reports and so on. Founder vesting means I came in as an investor into the company. I was betting on the founder. In any condition, I don't want the founder to leave. Now, if the founder says I'm leaving, then I feel what will I do with this company? So I have a right to get the founder's equity and sell it somewhere else. So that is called founder vesting.